Wendy's stock has suddenly jumped back into the spotlight, not because of earnings, but because of a surge in short interest and a full-blown meme frenzy. Retail traders have piled in, short sellers have pushed back, and Wendy's has become an unexpected battleground stock. But here's the reality. Wendy's hasn't reported earnings since early May. Even though the stock is up 26% in the past 5 days, the fundamentals behind this company have been deteriorating for years. So today, to understand Wendy's long-term risk and return profile, I'm using a Monte Carlo simulation to simulate multiple years market movement. Quick disclaimer, I am not a financial advisor. This video is not financial advice, and the analysis presented is for educational purposes only. Please conduct your own research or consult a licensed professional before making investment decisions. Wendy's became a meme stock because short interest spiked and traders saw an opportunity with remembering past short squeeze plays like GameStop or AMC. But meme attention doesn't fix fundamentals, and Wendy's fundamentals have been weakening for a long time. Stock is down roughly 66% over the last 5 years. That's not a meme dip, that's a structural decline. So before we run the simulation, we need to understand what's actually happening under the hood. Wendy's last earnings report was for Q1 and reported in May, but it still matters because it shows the trend. Revenue is only up about 14% since 2021, barely keeping up with inflation. Profit margins have fallen roughly 3 percentage points over that time. Year over year for Q1, you can see margins dropped by 23% year over year, and the only thing up in these metrics was revenue and their own expenses. This is a company that's been losing financial strength year after year. Over the last 5 years, Wendy's fundamentals have weakened across the board. Revenue growth is slow, margins are slipping, free cash flow is stable but not improving, and shareholder equity has been destroyed, down over 70%. That's a sign of aggressive buybacks, rising debt, or both, which Wendy's has had. Even with the meme rally, Wendy's long-term volatility is still low, but low volatility doesn't mean low risk. It means slow decline. The stock has been bleeding value gradually over years, not crashing suddenly. This matters for the Monte Carlo simulation because the model reflects a company of weakening fundamentals but still stable volatility, a slow grind downward rather than explosive moves. Below are the 10 sections I use my Monte Carlo sim. These factor in how the stock is going to perform over the next few years depending on its ranking. Here are the results for each section. For revenue quality and growth trend, that was ranked 4 out of 10. Slow growth barely beating inflation. For margin strength and trajectory, that was rated a 4 out of 10. Margins are falling, not stable. For balance sheet strength, that was rated a 3 out of 10. Shareholder equity is down 73%, which is a major red flag. For valuation versus growth, that was rated a 4 out of 10. Valuation is not cheap relative to declining fundamentals. For competitive position, that was rated a 5 out of 10. Brand is strong, but losing ground to McDonald's, Chick-fil-A, and Five Guys. For management capital allocation, that was rated a 4 out of 10. Buybacks and debt have weakened equity dramatically. For earnings momentum, this was rated as a 4 out of 10. No momentum, no catalyst, declining profitability. For macro sensitivity, this was rated as a 6 out of 10. Fast food is a recession resistant, but Wendy's margins are still failing. For 9, sentiment and technical trend, 3 out of 10. Stock is down 66% in 5 years, clear negative trend. And for 10, cash flow sentiment strength, I gave them a 5. Franchise royalties are stable but not improving. So total score 43 out of 100. So for my Monte Carlo simulation, here we have this Monte Carlo that I built. It's through Excel. You can see the stock name that we have here, which is Wendy's, the market cap of Wendy's, as well as the price of Wendy's, the current close of Friday. It's a consumer cyclical stock. Below the chart too, I have this year showing the past year of Wendy's stock price history, which goes back, for a year, showing that it was $11. Down here we have our different metrics for the Monte Carlo. I have a min, max, and median that's pulling each of these, over 2,000 simulations that I ran, showing the different data that's there. And we can see, the quartile ranges and the 10th percentile for stock price, as well as the dividend and the yield, the value, your profit loss percentage, total return percentage, and invested dollars, as well as technically dividends paid out if it pays a dividend. So for Wendy's in this situation, we're going to assume an initial investment of, let's say, $1,000 with an annual investment of $1,000. Now from here, this simulation is going to run once I type in yes to the box above. And as I type in yes here, it will now allow the simulation to run. And as the simulation is run, it's now showing through the simulation that there is a min price of $3.12 it saw in one of the simulations and a max of $11.47. as well as a median price range of 780. So really no change in a year. Again, this is just a Monte Carlo simulation. This isn't financial advice to purchase anything. This is just, showing hypotheticals and what ifs for the stock itself. Dividend, of course, stayed the same. For the yield, we can see a part where the yield is at 17%. That's probably because there was a very poor year that stock had, which probably led to a dividend cut happening. We can see here that, worst case scenario, they lost 770. Best case, they made $700. And dividends all stay the same. Of course, that's only after year investment. So now we wonder, well, what if we change the outlook to a higher projection, higher outlook? So we'll go to 3 years. And we can see here in a 3-year Monte Carlo simulation, we can see where, the min price of the stock came out to $1 and the max was $16. So hypothetically in 3 years, $16 or potentially $1. Median price looks like it still stays the same. And the dividend we can see dropped to 14 cents right there due to a potential dividend cut that it had. With that being said as well, we can see here the profit loss in this different category, profit loss of 63% at one point and a loss of 61%. But for the median, average loss of about 4% with a total return of 4.8%. Now, if we decide to potentially forecast this out further, we can do that as well with this Monte Carlo simulation. We can come over here, we can forecast this out further and go to a potential 15-year model, which will show us how long, it could potentially go for. And you can see here the 15-year model, the max is at $33 and the min came to 29 cents. Median of about $5.02 for the stock in all these simulations that we're running. So in 15 years, right, there's a hypothetical that it was almost bankrupt, or going pretty high up, almost 4 times higher than what it currently is. The quartile showing, where the different data points were falling, for Q1 and Q3, and as well as the 10th and 90th percentile. And again, just showing here the different data that happens with that. A max of potentially $33 with that median price of $5. So it did show in 15 years that the simulation showed that it was just going down overall in general. Now, if I come over here, let's say if we factor in this meme rally that it's kind of seeing and the surge in that, if we wanted to add additional points to its benefactor, we'll just add 10 in here, see how that impacts the overall stock. And we'll have to come back over here and rerun my simulation model. So I'm going to come over here and let's say we're going to pick, between, we'll do 1 year for here. We're going to select that and see how it looks. And we can see technically now factoring in that additional positive score, my rankings, it would show 1 year from now the stock could potentially be 1162, but even as low as 390, just based on all the simulations that are being ran. Median price is still coming in at 780. So it is interesting to see that, after all 2,000 of those simulations are running, it's coming back still as the same price within a year. The max, of course, being 1162 and the min being 390. So from that, you can think too that if the max is 1162, the market cap would almost double at that point. Potentially it would almost be a $3 billion market cap. And looking now too at the median rate, again, still stays the same. If we come over here and we look at, of course, the dividends, these didn't change. It's still just a 1-year chart. And again, for the past year, Wendy stock has gone down a lot. Now, if I come over here and let's say we change the simulation now to a 5-year model or potentially 3-year model, we can see some of the differences, how it goes from there. So we'll do a 5-year model, see what changes. Now we can see here in 5 years with that additional positive sentiment with its ranking, you're looking at potentially a price of 1921 through these simulations, as well as a minimum price of $1.70. So again, the simulation factors in, something could go really well for the stock, something could go really bad for the stock. It just depends, on how that'll go for it. From here as well, you can see that it did just update again because it is random numbers calculating in the background to where it was even a higher max from there. So potentially in 5 years, it says it would be $20.59, but a low of $1.55. So that can, just happen with all these simulations, right? And that's kind of what this was to pull up, was how the stock performs in this time frame from here. Um, you know, so what does this all mean? Wendy's is not a stable, slow grower. It's a declining brand with weakening fundamentals, failing margins, collapsing equity, and a stock price that reflects reality. The Monte Carlo simulation shows a company that could go up or down. There are many factors that could go into the company. It is possible for them to complete a turnaround, um, potentially, of course, but only time will tell. If you want me to run the same simulation for McDonald's, Chipotle, or Domino's, just let me know. Thanks for watching, and like and subscribe for more. Thank you.